Welcome, everyone. It's Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today's session is the best practices in family office direct investing. It features Molly Simmons, founder of McFarland Partners, and Patrick McCloskey of Aeterna Captial Partners. To give you a little bit of context, as I mentioned, Molly is a founding partner at McFarland, a boutique firm specializing in private investments and business strategies, especially for family offices and family-owned enterprises. To give you, from my perspective, a little bit of context, she also was a managing director at a prominent single-family office. So she really understands and has been in this business a long time. And Pat, I haven't seen Pat in years, but he also is wonderful. We're so fortunate today. His organization is a family office-backed private investment firm, and Pat also leads a family office affinity group, something I would know a little bit about, which shares investment ideas and best practices. Molly and Pat, welcome to the show.
Thank you, Angelo.
Great to be here.
Well, I feel like we've been talking about investing in private companies. Let's see, since like the first day I launched Family Office Association, which was about 13 years ago. Wow, time flies. This has always been an incredible topic, and we're going to get into the reasons why: potential for outsized returns, control, more engagement, but there definitely is more challenges and obstacles than simply just farming out to a private equity firm, etc. We'll talk a little bit about all of that today. So Molly, why don't I start with you? Then Pat, feel free to jump on in. What are the trends with families on direct private equity investments?
Thank you. You know, what we've seen is a dramatic increase in not only the number of family offices, but the capital under management with those family offices and the amount of that capital that's being allocated towards direct private. So I think there's something like 10,000 family offices around the world right now. Many recent studies have cited that the number of new family offices that have been created recently, the number of those that want to pursue direct privates is going up markedly. So across the board, from the studies to just the informal conversations, I've seen almost every family I talk to is interested in doing direct private investing. One thing that I think makes our conversation today more important is that the competition has also gone up dramatically in terms of the competition for direct private investments. So, Pat, I don't know if you want to share your background on that too in color.
Yeah, Angelo, just anecdotally, so about 5 or 6 years ago, you hosted a panel at the Westchester Country Club with the FOA, and the topic was family offices and direct investing. And I was on the panel with 4 or 5 other folks, and we were talking about this very topic. And I will tell you, since that time, the level of interest and the level of direct investment activity on the part of family offices has unquestionably grown. We talked about it then as a trend, and that trend has really only gone one direction, and that is up. But what Molly says is absolutely true. While that's happening, there is more and more competition. The private equity firms are getting bigger and stronger. The family office groups themselves are organizing more, particularly the larger ones. They're institutionalizing more. It's a large playing field, and what we're going to talk about today, there's lots of different ways to participate as a family office, and there's some common pitfalls that we can point out as practitioners ourselves that will hopefully help folks, embark on this prudently.
If I may, my question would probably be kind of why. So I'm assuming investing in private companies because you are going to accept an illiquidity premium to probably get a 300 or so plus basis points extra return compared to what was a roaring market in the public markets for over a decade, including, although concentrated, during the COVID times. And then, like you said, the professionals that have been doing it for years, that have teams, that have infrastructure, they're getting more and more active in it, looking at distressed opportunities, et cetera. Are families really going to be able to have the fortitude to build up the teams, and I know we're jumping the gun a little bit here, and compete with quote unquote the professionals, that seems pretty tough to me.
Well, I think that's a great question. And that's something that families should consider up front when they're thinking about what they want to do. But just, building on what Pat was just saying, we probably got over, I don't know, 1.4 trillion plus in dry powder and private equity, strong balance sheets and corporates. So jumping into that water and saying, we want to get great returns, and we're going to compete with the thousands of PE firms playing that game exactly that way. That's very hard unless you have the skills and the resources internally to do it. What I see as a path to success is when families can say upfront, this is why we're doing it, because sometimes it's more than returns. There might be other reasons, in terms of being a more values-driven investor. Maybe they're trying to learn about a particular industry because they want to make a bigger investment down the road. But, being really clear with why you're doing it and then your path to doing it. Just because you can write a big check and then jumping in and saying, I'm going to compete with the thousands of private equity firms, that's going to be a really difficult path to pursue.
Yeah. And I think, the level of dry powder that Molly mentions, the trillion plus, the preponderance of that comes from the mega funds, the Blackstones, the Apollos. I mean, most of that capital is coming from these large mega funds. We're not talking about family offices competing at that level. There are a few, the Michael Dells of the world that can set up effectively institutional level firms. We're not talking about that, Angelo. We're not talking about competing at the kind of mega buyout level. We're talking about, and this is a question, is, for example, our firm, Aeterna, I work with two families, and we're very focused on buying family-owned businesses that are going through a transition where the owner is likely a baby boomer that doesn't have a next logical buyer for his or her business. And these are lower middle market companies, 2, 5, 7 of EBITDA.
Sure.
The big private equity firms are not competing there. And where can we as a family come in and be competitive in that situation? And that's something that Molly and I spent a lot of time talking about, looking at opportunities together, where we think that you can really play to the strengths of your own DNA, of your own family, of your own, sort of enterprising instincts that helped you create your family fortune to begin with. And control your destiny a little bit more, Angelo, as opposed to going in and passively being a limited partner in somebody's fund. And they're not mutually exclusive. I mean, one of the things we'll talk about is there's a case to be made for having fund level investments, but then also having an allocation and a strategy around directs. But if you're going to invest directly, you have to have a strategy around origination, around due diligence, around monitoring that investment. The hard work really starts after you make the investment. So, there's a whole strategy around that. It can be done, but it requires a real concerted effort, and it requires a strategy. And one of the things Molly and I just recently wrote about are what are some of these models and what are some of these strategies.
And maybe a follow-up on that to Molly, and I think you hinted at it, Pat, especially if the wealth creator is still around, kind of started something from nothing, had a liquidity event that was significant. So they obviously know a specific industry. So the vertical that they're familiar with, that have knowledge on, that have connectivity on, maybe that should be the vertical they could be a direct investor in because they have relationships and contacts. I would think that for the most part, unless it's a Michael Dell, $10 billion plus family office that could legitimately one-on-one compete with big private equity firms, like Pat said, most are going to have to be more nimble and look at smaller and specific verticals where they have experiences in. What would you recommend?
Well, or partner with others is where we're, I think, going to go with the conversation, is that it doesn't have to be all about you. But I think it's important, to your point about, well, maybe they made their money in one area and then they're looking to make direct investments, is to think about where you're at on that spectrum of being an operator. If your family and your entity is set up to own and operate businesses, are you looking to be more of an active investor, a passive investor, or are you really set up to be more of like an asset allocator? Understanding that up front and knowing that, you might be different from another family is key, because if you're not set up to go acquire companies and get down that path, it can be a mess. And just building on what Pat was talking about in terms of just know where your strengths are. Pat and I often talk about this discussion of, where are you relevant and unique? Where are you that next best owner and investor with your enterprise? So I think thinking about that spectrum, where do you fall? Where are you relevant and unique is really important. If you do have the skill set and the resources to what you were talking about, Angelo, kind of start going one or two clicks away from that main industry that you know really well. Maybe you're going to make direct investments in that. That's great. What some families look to do is say, okay, I don't want to be fully concentrated in this. I was 100% concentrated in my life. I'd like to now use my strengths there. And maybe part of my strategy is to diversify with partners. So where am I going to be really strong in making that direct investment? Maybe it's my industry expertise. Maybe it's functional, like distribution, my contacts. But where can I partner? You might partner with funds, independent sponsors, but other families. So if you made your wealth in, let's say, food and ag, but you're looking to diversify, you might partner with other families that maybe are deeper in manufacturing, and you can share your complementary skills and resources.
Yeah.
But it starts with thinking strategically up front with, where are you and where do you want to go?
And then I think adding to that, Angelo, what Molly just mentioned, then there's the question is, okay, what type of investment are we talking about? Are we talking about an active control investment? Because that requires a very different level of resources than a more of a passive minority investment. So take Molly's example. Okay, you've got food and ag expertise, and something comes across your desk in the, consumer sector. Well, is it a control investment? Are you talking about buying control of a business? Because that is a very different proposition than taking a minority equity stake that's going to be more passive. And then one of the questions we immediately ask is, well, who do I know that knows more about this than I do? And that's going to be my next phone call. And that who is part of this kind of ecosystem, which you do a terrific job cultivating, Angelo, around other like-minded families that have expertise in certain verticals, but they also have just an outlook that tends to be a little more patient and sort of long dated than maybe a more clinical and short-term oriented private equity firm. But that doesn't mean that the level of diligence that you do is any less stringent. I mean, it's the same level of rigor that you need to bring to that opportunity, but you can bring other families around you to help you not only on the diligence, but also to share some of the financial risk as well. So more intellectual horsepower, more financial horsepower. And, we haven't made an investment yet where we haven't co-invested with another family group. We just do that because it just makes a lot of sense to us, because we can fight above our weight much more. Because most families, let's face it, they're pretty lean infrastructure, right? Angela, people don't want to build up big internal teams. Most families don't want to do that. So to fight above your weight and stay lean, you almost by definition need to do what we're talking about.
And maybe related to part of that, Molly, is, okay, let's say there is competition between a private equity firm and a SFO or a group of SFOs. The private equity firm is a hardcore commercial enterprise. They need to satisfy LPs. They have certain I would say, conditions or limitations on time constraints. Now the advantages to a family or a group of families, they may have much more time on their side, may be more accommodating to a longer term perspective. And although not always the case, but may be able to also move much quicker on certain deals. So it's not to say that families or family investment groups are never going to win against PE firms. Actually, if they're selective and strategic, I think they could do very well.
Well, I think it's to that point about being selective and strategic, what you just said, and going back to some of Pat's comments about the focus, what are you trying to do? In my experience, I have found that it's rare that a family or a family group is in direct head-to-head competition with a PE firm. It's happened on some occasions, but I think it's rare, as I think most families are looking for either investments that are maybe they're not coming through an auction process, or they're coming from relationships they know, or they're playing selectively if there is a process where they know there's a reason for them to win. And oftentimes that reason is the industry expertise, like you said, or it could be that's a family-owned business that wants to be acquired by another family office. To win in those kinds of situations, I think it starts with really knowing up front in your initial screen, like why are we going to earn a right to win in this situation? Is it our industry expertise? Is it that this is ripe for a family group because the seller really cares who's the next best owner? Is it that this company would really benefit from a long-term patient capital environment, meaning maybe you need to continue to make investments and that might be hard for a PE firm to keep doing later in its life? It starts up front with saying, why do I want this investment, and why am I the next best partner? And I think it's often fair to ask that of the deal sources and of the management teams up front, like, why are they looking for a family partner?
Yeah. Yeah. The situational analysis is really, really important because the opportunity cost is so high, because you are lean and it's just, you just don't have a lot of bodies and people to throw at these opportunities, Angelo. So you have to be very, very careful what you pursue. And as Molly said, you have to really assess the situation. How am I viable here? Why can I be competitive? If it's an auction and there are a lot of private equity firms that are involved, you just have to really ask yourself the question, why me? Because sometimes it's best to just step back and pass and, move on to the next situation where you can develop a bit more of a relationship with the counterparty. And it's less of a clinical process, because we don't do well in that environment. It's just, when you invest on behalf of a family, the relational aspects become very important, and their strengths, and you want to play to those strengths.
And I think a point on that, just to build on what you're saying, Pat, is years ago, some of these factors that you're talking about maybe weren't as strong. A family might have been able to say, I can take my time, I can find this investment, and very few people can write the kind of check that I can. But now what's happened with the competition that we cited is there's lots of people, whether they're institutions or not, that can write these checks. So using the playbook of maybe 15 years ago, maybe it was just building one operating company, is often hard to do if you're looking to build a portfolio of direct privates.
Yeah, and just you said it, Molly, a portfolio. A common pitfall you see, Angelo, is someone makes one direct investment, right, and it was in the hospitality industry a year ago, God forbid, and that was it. And then, so if you're going to go direct, you really need to be thinking about a portfolio for obvious reasons around just diversification and risk management. And, the mandate that I have from the families that I work with is to build a diversified portfolio. That's the mandate.
And that would seem to make sense, I suppose, digging into that a little bit more. If they're looking to make controlling investments where their strategy, possibly changing C-level executives in the company, so internal or external recruiters, that's much more engaging. Now, yeah, they're punching above their weight if they're working with other families. But if they're looking for a diversified portfolio of controlling interest in diverse companies, and they're so hands-on in the management aspect, I mean, maybe they want to be, they enjoy that, they find it engaging, but that takes up the level of complexity, controlling versus non-controlling.
It really does. You're absolutely right, Angelo. If you were going to build a portfolio of control investments, that's a very, very different just level of commitment and resource that you need versus maybe more of a mixed portfolio. You might have a few control investments, but then some minority investments, maybe even some loans to some businesses that were less, time consuming. But you're absolutely right. If your strategy is to control businesses and control them, then you are, and you want to build a larger portfolio, you're talking about needing a bigger team for sure.
And that goes back, I guess, Molly, since you have experience in the SFO and consulting with families, probably one of the challenges or negatives that families that do want to be active in direct investments, especially more controlling, is the fact of they need to have the internal resources. Does the family or even the C-level executive know how to hire and fire? Do they know how to incentivize? They need to attract people who are probably doing pretty well already in private equity or investment banking. And how do I know the capital is going to be deployed? What's my compensation? Do families really want to roll up their sleeves and be that hands-on and active in the process? And the answer is, yeah, some do. But I think some others look at it and say, wow, I need to build a team of 5 or 10. I need to manage them. One of the reasons why I had a liquidity event is so I don't have to be as hands-on anymore. What are you seeing?
Well, I see a mix of different models out there. So some are, as we touched on, and Pat, I think you said it, very lean. They're opportunistic. They might do some control here or there. They might be doing some minority. Others build, as you were referencing, a very large dedicated team. They might have a very formal capital allocation to that, running it like it's an internal private equity fund. And others kind of have a hybrid model. They have maybe a smaller team. They do certain things on their own, and then they do a lot of partnering with others, either institutions or other families. But one thing that I've seen is even very large multi-billionaire offices who have a big team to do direct privates, they also still look at partnering with other families. So they might say, well, we have the industry expertise or the skill set or other resources to be the lead on this. But we want to partner with these other families because they're bringing something to the table that's value add and de-risking, more than just capital. So I'll give you an example. There was a control transaction that I was working on. So it was a buyout. We found it. It was a family-owned business in a business sector that was manufacturing a certain type of packaging. So the family that I was working with could have acquired the whole thing on their own. It wasn't about the capital, but it was about, are we better together if we bring in one of our friends and colleagues to be a partner, another family office,
Right.
Long-term view. We both could have written the check. And so if either one of us had to get out, we could probably have recapped each other out, but we were very complementary. And this other family had very deep packaging expertise, which was value add. Together, we were able to come up with over a page of customer introductions for this particular family, but we were like-minded from a values perspective. We were complementary from a skill set, and it made the deal better for both parties to partner, even though both had very large established teams and a pretty big cost ticket to keep those teams going. Still, the larger teams partner. Smaller ones, let's say they're, like Pat said, they're not going after what $1 billion fund or very large family office is going after. They're looking to partner for many of the same reasons: share the risk, leverage each other's complementary skill set, and really work almost as one bigger team together.
And Pat, in terms of you can't invest in good deals if you don't know where to look and don't have enough deals to look at to pick out the right ones. What are some recommendations you would make to single family offices or consortiums of family offices in terms of deal flow?
Yeah, well, that's really the lifeblood, Angelo, is the deal flow. And I guess the question would be, what kind of deal flow are you interested in? Are you interested in the control deals, the businesses that you want to buy? Are you interested in particular industries? Do you have children that are interested in particular industries and you'd like to invest in those businesses to get your children more engaged in businesses that you own? There, I think to ask the question, well, what is it that I'm looking for? What sort of financial commitment am I able to make? Because that will in some ways determine the type of deal flow. A lot of times, we find there's industries that are out of bounds. Some families just don't want anything to do with cannabis or gaming or certain industries. So, you just discount those. But, we had a call this morning. So I mentioned to you that we're interested in buying these businesses that are in transition, that are owned by baby boomers. There's an estimated 4 million businesses in America that are owned by baby boomers. So they're going to transition by definition because of just aging demographics. So we've got a proactive calling effort. I've got 2 people that are working with me. Well, we're calling on certain businesses, certain size, certain geographies, just proactively. So that's a very proactive approach. We have this affinity group that we've created where we were all interested in direct investing, and we share opportunities with each other. That's what we do. And we just closed something last month where 6 families all invested in a media business. That deal flow came in through one of the families that was making the investment. There was room for more, so they shared it with the group, and about 5 of us kind of tagged team the diligence and invested together in that. That's a great example, and that's a minority investment. But someone's got to own that investment, Angelo, after it's made. And back to what Molly was talking about around different models, whatever your model is, whether it's an in-house team that you've built or it's kind of a hybrid sort of insourced, outsourced solution, once you make the investment, who owns that investment? Who's responsible for keeping up with it? And how are interests aligned such that the outcome of that investment is going to be optimized? And that's something that's, I think, also very, very important, is the alignment of interests with the family and those responsible for actually making the investments.
And Molly, we kind of went around it a little bit, but maybe asking a little more directly, once a family or consortium of families finds an investment, what are best practices and tips on closing and managing that investment?
Yep. Well, I just want to build on what Pat was saying. I had a great quote from a family the other day that they were trying to be more focused and they wanted to go after proactive sourcing, which I think is key. And they said, we're trying to move from driftwood to a strategy. So many families they let things come to them versus being focused on where is it a great fit for me and great family partners. But in terms of how to close and manage, it goes back to what skills and resources do you need? What do you have internally? And what can you do in terms of your partners, whether that's your family partners, through affinity groups or others, or other partners. So in terms of closing, one thing that I see is families that have acquired companies as part of their platform over the years, they have a certain diligence and cadence that they do. They usually know those companies really, really well. So diligence is often easy. But then when they move on that spectrum a little bit to maybe they are buying a company in a different industry, they still have all the heavy lifting of finding and closing and managing it, or maybe they're sharing control with another family, that's where you really need a consistent and rigorous diligence process, because it's different than that industry that you built your business in for 15 or 20 years. So being really consistent about evaluating things like, how do I evaluate the management teams? How do I evaluate the strategy, the financials? When do I bring in outside third party, like quality of earnings analysis and tax and legal? a lot of times people are very focused on diligence to make sure that they're doing great investments. A side part of that is to make sure that you have a process and governance to approve things. So it's not just, well, this arm of the family wants to do this deal, so they always get that done. If you really set up a clear diligence screening and process to close, you avoid some of that political push-pull because everybody's agreeing up front. You also asked about managing.
Mhm.
When a family is going from being just that pure owner operator to a little bit more of investor, all of a sudden that how do you manage it and how do you create value post closing, those questions come into play. So if it was corporate M&A, they might have just integrated the back office, reduced cost, had some revenue synergies. Well, now when they're buying a company in a different industry or partnering with others, they have to think about things that are maybe more than just reducing costs and revenue synergies. So it might be things like, how do we grow this? Maybe it's add-on acquisition. How do we take the team to the next level? So that might be adding to the management team
Absolutely.
and also other operational and strategic improvements.
Yeah, and I think on the diligence topic, when it comes to co-investing with others, Angelo, that's where the strength in numbers really starts to shine, where you're all looking at the same investment. And it's not only what you know, but who you know. For example, the media company I mentioned that we closed on, one of the families looking at the deal happened to know someone well who knew the CFO of the business. So he was able to make a reference call that, had he not been part of the group, probably wouldn't have been made on this CFO. And that's a really good example of just this fighting above your weight, where you're kind of you're working together, and at the end, some may opt in and some may opt out. That doesn't mean you're all going to close, but you're all trying to get to the same place, and that is understanding the opportunity and understanding the risk as best you can. And then when you do close, someone's got to be responsible for really, really monitoring it. And if you're going to take that on as a family, that's terrific. And others who know you and trust you may trust you to be the point person on that, rather than recreate the wheel when you don't need to.
No question. And those are all the power of community and families coming together. I'm going to ask a question, but before I do that, a heads up to our two participants and everyone. I do have to make a tweak to my Zoom. So I'm going to ask my question. We'll kick it off to Molly. I am going to go off video and be muted for about 60 seconds. That's it. You're not even going to know I'm missing. You're going to be glad that I'm missing, that I will come back and have follow-up questions. But to kick off that time, Molly, in terms of best practices, what are one or two key watch outs to avoid?
Got it. Well, there are many depending upon the situation that you're in. And I'll highlight a couple here. But one thing I wanted to build on Pat's comment about partnering with other families. It's important when you're working with them on an investment, but what I found in the family networks that I'm a part of is they will often help you even if they're not in that deal. So they might be prohibited from investing in an industry due to conflict because they're already in a company in that industry, but they will often help you understand that industry and those contacts. So some watch outs. One big one that I see is alignment, and we touched on this a little bit. One is, if you're a control investor, you need that alignment with your management team. Sometimes the management team is used to getting big incentives that they might get from a private equity fund related to growing and then ultimately selling that company. If you need that management team working for you for long-term value creation, you need to come up with incentives that are market-based and aligned with that team. And you can do that even if you're a long-term holder, right? You can create your salary, your bonus, and then interim incentives, even if you're going to keep holding the business. Another key point about alignment, and this touches on what we've been referencing in terms of families working together and being maybe a minority investor in a buyout and leveraging each other's expertise, is making sure there's alignment with your partners. So that's things like, do we have the right economic rights? Do we have the right governance or information rights? When this goes well, are we all doing well together? Or is there a mismatch in that risk reward where one party might be a little bit incentivized to lean one way or the other? Or if one party needs to get out of the investment, let's say one family in the group needs liquidity more quickly than the others. I think really thinking about how are we aligned up front as partners, and where can you avoid adverse selection? Like, why am I seeing this? Am I seeing this because nobody else wants to do it? But then also alignment internally. You know, Pat touched on it earlier when he was talking about if you're going to be doing these control investments, you need to have a big team. Whether it's control or minority, you really need to have alignment with your internal team. That's incentives, but it's also strategically, are we all on the same page that this is what we want to do? I've seen countless times where there's misalignment with what the family wants and what that investment team might think is right, and then what the incentives are pushing them to do. So I think as long as you're thinking about alignment up front, it should be a good way to avoid some watch outs.
Yeah, and just maybe one or two more, Angelo. I think that, if you really are focused on, cash flowing businesses and the odd venture deal comes in, just it's so tempting to go after it, but quick no's are really important. And back to deal flow, if you really want quality deal flow and you want that deal flow engine to keep moving, you've got to be, very timely and respectful of the sources of the deal flow. So just being prompt with people and honest with people is really important. The other I would say is, oftentimes families underestimate the time that they're actually going to be in the investment and the requirement for needing to put in additional capital. I mean, if you looked at what's happened in the last 12 months, you might have invested in something 18 months ago and thought, okay, well, that's it. The business doesn't need any more capital. Well, sure enough, they do. And if you don't re-up, you face the prospects of dilution. So I think you have to keep capital in reserve, which private equity funds do a good job of. That's part of their disciplined approach because they know that oftentimes their portfolio companies will need additional capital. So I think families sometimes underestimate that.
Yeah,
it's
that's
a long-term game, right?
Why do families pursue being a direct investor or a consortium of families direct investing versus funds? I did have one family share with me as an investing centric family, oh, we're not necessarily doing it because we think long term we're actually going to get greater returns. The math has shown, actually, because we're active in both direct investing and PE, that it's relatively about the same. So that goes to the question of, again, why do direct investing? Is it control? Is it you feel more engaged? And you hinted at one that I think is underrated earlier, and that is the next generation. This is very hands-on to them about how businesses work.
That's a great question. One family just that I was speaking with yesterday has said that their direct investing together with the family principals and other families is what is keeping their family together. It is what their next gen is focused on, not just financially, but also strategically and operationally, whereas some other families might have been sticking together in the operating business. But the question of, why you're doing it and thinking through that up front is an important one. Certainly some are doing it for returns, and they might be saying, well, we can create better returns directly investing and maybe avoid some or all of a management fee or a carried interest. But as you were indicating, sometimes you're not always performing better. And a good friend of mine has a phrase that 20% of zero is zero, meaning if you think you're circumventing the carried interest of 20%, but you're not very good at it, then you might have been better off partnering with the fund instead. So if you're financially oriented and that's your primary goal, you should really understand how you're set up to perform versus funds, or where you say, well, listen, I might be better and have an angle in this industry or these types of companies, but over here, I might partner with funds in this industry I don't know well, or these types of deals where I wouldn't get access to. But usually there are other reasons why families pursue it. It can be, I want to be more involved and control when my dollars are going out the door. I don't want to be tied up in an illiquid investment period with a fund. They might want to have influence over the company, whether it's control or maybe they're on the board.
Yeah.
And they just want to get more involved. A lot of times it's values. They want to push their values, or they want to learn about a certain type of business or an industry. Go ahead, Pat.
I think, Molly, I think the last point, the learning benefits, Angelo, just you learn a lot when you invest directly because you have to. Whereas if you go into a fund, you're just more passive. So it's learning benefits for the whole family, which are really can be quite valuable. But again, they're not mutually exclusive. It's not this either or necessarily. There's a real case to be made for in certain situations investing in a fund, and in certain situations investing directly. They are very different investments and they require very different resources, but they're not mutually exclusive by any means. And the co-investment rights that you can gain as a limited partner can be very valuable because they often come with, no fees, no carry if you're an LP in somebody's fund. So that can be beneficial. But, speaking for the European family that I work with, I'll tell you that the liquidity management is very important for them when it comes to directs, because they're making the call on the direct investment. They know exactly what their liquidity is, and they're saying, yes, we can invest, today with this sort of a time horizon. Whereas when you put a commitment into a fund, you're getting capital calls when you're getting capital calls. You don't know when you're going to get the capital call. So it's just a different, there's just a different liquidity management issue at play. But I really believe that this next generation learning about whether it's cryptocurrency or fintech or whatever the interest is, if you're going to invest directly into that business, you are going to learn a lot about it. In addition to it being a very sound financial investment.
We might want to add about why some of the families want to learn about it. So that and function of, maybe you do directs and funds is so important. One family that I'm working with, they invest in funds and directs. They invest in funds where they're trying to learn about an industry where they might do directs later, but they want to get exposure to the sector, the drivers, but they realize they're not strong in that area. So they're trying to gain that expertise over several years. The learning that we're talking about can be different for each family. One family is that I work with is trying to learn from minority direct investments and have a nice diversified portfolio of those, with the expectation that down the road, they might either acquire one of those to be a major platform that they run, or they're going to use those learnings about diverse industries to say, well, we want to build a platform again now in this industry based on what we learned about investing or partnering in those others. Meaning sometimes it's learning just because they're interested, but often it's learning because there's a longer term investing or operating goal in mind.
Yeah. And don't you think, Molly, the DNA of certain families, speaking for the two that I invest for, very dynamic, very entrepreneurial, very business building minded. And the idea of investing in in an index fund or a private equity fund, it's just not interesting to them. They really want to be much closer to the business and building a business. And they're operators, and they're really good at it, and they're very entrepreneurial, and they're not investors. They don't know how to invest in private equity because it's not what they do, but their instincts are so good, and they really want to invest in business. And that's just part of who they are. And I think that's true with a lot of families.
Yeah, it does come down to the DNA and where they're at on that spectrum. And that's usually in terms of being an operator, an active or a passive investor, or an allocator, that's really going to drive a key part of the strategy.
Yeah, I'm so glad you said that, Pat. That is so true. And that's what makes, one family office, one, they're so unique, especially those that may be more a wealth creator or still around and very hands-on. They're probably more entrepreneurial, more of a risk taker. And I know people are going to listen or watch it and say, just go on a yacht and enjoy your time in beaches. It's just not in their DNA. They might be able to get the same returns investing through high quality funds. It's just not who they are. They want to be engaged. They want to be hands-on. Now, there is an other approach. It's a little more common in VC. I don't notice it as much in private equity, but basically it's a single member fund. As a family, or arguably a group of families, you approach a smaller to mid-sized private equity fund. You probably have a relationship with them. Would they be willing to create a specific fund where only you and select other families could come into? If it's a larger scale manager, unless you're talking crazy money, that's not going to happen. But for smaller managers that may be talented, have a niche, but you don't want to manage them internally, or they don't even want to come in internal, I see it more in smaller scale VC. I don't know if that's taken off yet in hedge funds and private equity. I would assume not.
Well, there are a lot of different models out there. I think it's harder for an established fund to say we're going to create this sidecar vehicle for one limited partner,
Right.
if that's, spreading out their resources and their strategy too much, and there's misalignment there. What does happen is certainly families come together often. When they work well on one deal, they will come together on another deal, and you have a group that might keep working together. And sometimes they're backing an individual manager. Sometimes that's an independent sponsor that is focused on a certain type of deal flow, and then working with those same families or even one primary family to back them in a deal. So it's outside of a fund. In addition, there are search fund models where one family or multiple families could fund some of the operating expense with one partner to have the right, but not the obligation to invest.
Yeah, those are interesting models. For years, I've been looking to get on, what's his name? I think a professor, a former professor at Stanford on that kind of model, Irv Grossback, off the top of my head. I do find search funds to be intriguing. Pat, what are some key questions that family principals or family office staff kind of may need to internally be asking themselves before they become more engaged in this?
I think, whenever you're talking about illiquid investing, Angelo, you're talking about, risk and assessing really what sort of risk tolerance do you have? What sort of capital do you actually have that you're comfortable tying up, in an illiquid nature for a number of years? I think that's really, really important. Just assessing your own risk tolerance, your own liquidity. I think asking the question, why am I doing this? Is it because I just want to learn more about other businesses? I want to bring my operational and my entrepreneurial, instincts and skills, to bear on an opportunity. What am I really willing to absorb in terms of cost? That's another question where I think
For sure.
families, they like the idea, but then when it comes down to the costing of it and the budgeting of it, because it doesn't just happen, right? You need people to make it happen. I think that's a question, Angelo, that should be addressed early. What kind of cost am I willing to put into this, which then begs the question, well, what can I expect in the way of returns? And you need to just really try to figure that equation out.
And maybe, Molly, I'll ask you a different question as we kind of take it a bit to a close. What are the characteristics of a strong family office co-investment partners?
Really important question, especially especially since you might be relying them on one particular deal, but also in helping you in other ways, whether it's diligence or could be other advice about your family office investment group too. And just as a side note, the families that I've co-invested with, what I found is it's led to other investments and partnerships outside of the private equity. It's led into publics and others. So number one, I look for shared values. Like, do we kind of look at the world the same way in terms of how we look at people, what we're trying to do here? Like just general shared values is a key one. Another one is, do we have complementary or overlapping skills? So it could be industry, overlap. It could be functional. Boy, Angelo's group is great at sales and marketing. Our group is great at internal ops. Together, we, to use Pat's term, fight above our weight. You look for that where 1 + 1 can equal 3 coming together. Another point that I would look at is a resource fit. And some families might partner with a family that's leading a deal and they know, listen, I'm a small piece of this. I'm a minority player. I know how to play my part here. That's fine. Both parties know there's a resource fit. We also have a values and a complementary skill fit. But where two are coming together and maybe they're sharing the control, it's really important to know that both parties have the capital and the long-term commitment, that one family isn't going to say, hey, I need to get out now in 3 years. And that if that does happen, that the other family could probably have the resources to do that. Where there's a mismatch with the capital that's needed and the timing to get out, that can be an issue. But it also just comes down to things like, hold periods and governance. If you have 1 to 3 people controlling the investment or leading the investment, they can usually make those decisions together. If it's too many, it becomes cumbersome. So when partnering, what I've seen is, 1 to 3 people can kind of lead for the group. But if you have 5 people, it's often hard to get everybody on the same page. So looking for that alignment on the hold periods and the governance upfront is key.
And Patrick, maybe the final question for you, in terms of best practices in family office direct investing, like the title said, we covered so much today, but is there maybe one area that we didn't spend time on that would fall under the auspice of best practices that could be a good parting tip for family offices?
Well, I don't know if there's one nugget to share, Angelo, that we haven't talked about. But it really is, having done this for a while and having met people like Molly. I will say that when you invest directly into businesses, it's just the personal skills required and the relational skills required and the trust that you develop with people and the camaraderie and the chemistry. I mean, it's just very enriching beyond the financial aspects. And when you are co-investing with these other families, as Molly said, it goes beyond the next deal. You end up sharing a lot with each other, and you learn a lot from each other, and that's what life is really about. And but this is when you invest directly, there are certain skills that you just have to bring to the table or you will fail. There are diligence steps that you just have to take or you will fail. And there are certain things you have to do after you make the investment. And there's a playbook for that. And we've tried to talk about some of those plays, but I come back to the relational piece of it. It's very enriching because by definition, you're working so closely with people.
And Patrick, for those that would like to learn more about you and your organization, how could they learn more about you or potentially even reach out to you?
Sure. Feel free to just call me or email me. Angelo, you've got my details. We have a website. Molly and I just published a 2-part article. Our contact information is on there. If people have questions, I'd be happy to answer them, and I'm sure Molly would be happy to do the same.
Given that most of the people will hear this in video or audio format and not necessarily have any direct connectivity with me, is there a LinkedIn page or a website that you host where they could learn more?
Oh, sure. Aeterna Capital is my my website, and on there is my email address, and I think even my telephone number.
And by the way, that is spelled Aeterna.
Yeah.
And the rest of that email is, or website, I'm sorry.
Aeterna Captial Partners. That's the
.com.
website. Aeterna is a Latin word. It means forever and everlasting, and that's meant to connote the families have that sort of time horizon where you're in this for the long haul.
And Molly, how about you? How could they learn more?
Same. My website is McFarland-partners.com, McFarland-partners.com. My email, molly.simmons@mcfarlandpartners.com. Pat and I co-authored a series of articles that you can find on our LinkedIn as well as through Family Business Magazine that are helpful resources, and would welcome the conversation.
Yeah, you guys have been great. I greatly appreciate Molly and Pat being on. Everyone, I'm Angelo Robles. A reminder, I don't know the time frame that you're listening. Anything with investing, you could always lose money. Everyone has different time horizons, risk tolerances, liquidity needs. This is for somewhat education and entertainment perspectives. You need to do your own diligence and very simply think for yourself and make your own decisions. I'm Angelo Robles, the host of the Angelo Robles podcast and founder and CEO at Family Office Association. You can learn about us at familyofficeassociation.com, and I'm active on social media, mainly all the platforms on YouTube or simply Family Office, which is probably the one recently we've been most active in. Thank you all so much. And again, thank you, Molly and Pat, for being great guests. Thank you.